Hello, everybody. This is Eugene Yashin with Signet Financial Management. Today it's September 1st, and I would like to update you on the U.S. stock market. Please take a look at all the disclaimers and disclosures. Today we'll talk about U.S. equities. I will update you on the size and style cycles. We will talk about yield curve and short-term interest rate spreads. We'll take a look at valuation spreads. I will update you on multi-factor, macro and micro forecast. Then we will take a look at micro factors at work. We will discuss which ones worked, which groups didn't. I will touch upon portfolio management and our recent rebalancing of our strategical equity portfolio and strategic dividend equity portfolio. We'll talk about what worked and what didn't work in those, and I will speak to changes we've recently implemented. As you all know, trade wars have been dominating the marketplace. Also, the fact that the yield curve inverted recently is not helping the sentiment. Although we do have to point out that on its own, yield curve inversion is not such a reliable sign of future recession as media portrays. Now, we still believe the environment remains very supportive for U.S. equities in the long run, and we still emphasize the importance of selecting and buying into strong fundamentals, and we are still on the lookout for growth at reasonable price stocks. And we do believe the recession is not imminent, but it does make sense to become a little more cautious and defensive. So from the value growth cycles, we find ourselves in a very long and a very prolonged growth cycle. It's been going on for quite some time, and the inversion is well overdue, but because of the trade war fears and heightened risk aversion, we do see market preferring, huge, large mega caps with substantial growth rates, which suppresses this mean reversion move into the value territory. The same thing we see in valuation spreads when we look at the difference between how expensive the most expensive cohort or quantile of U.S. equities is versus the value, the cheap companies. When the valuation spread is really up high, it means that the market is in a state of distress. You can see that over the last couple of years now, the valuation spreads point to market being very uneasy, and this uneasiness comes from obviously the trade war and the slowing down in the world's economy. Kind of the same logic gets propagated into the size dynamics. So small cap has been depressed for a while. Large cap, because people consider large cap safer, has been dominating the marketplace for a while now. And there's very unlikely to be a mean reversion move unless we see progress in trade negotiations. And the last but not the least, on the macro picture, we do see, we saw a short-term interest rate spread inversion earlier in the year, and now we see the classic 10-2 yield curve being inverted slightly, but just the fact that so many investors pay attention to it these days make it so much important for sentiment. So That's why Federal Reserve is considering additional interest rate cuts to reshape the yield curve from the inversion. The one thing I will say about inversion is when people talk about the fact that historically inversions did lead or did precede recessions, those inversions were actually orchestrated by the Federal Reserve, which was very aggressive with short-term interest rate hikes. This time around, it's quite opposite. It's all around the world. Central banks are providing all the necessary support and very accommodative monetary policy. So that's why when you look at Federal Reserve at this point is kind of a prisoner of the situation, so to speak, and they cannot hold interest rates high when the rest of the world just keeps plummeting them. So this inversion is quite special. And when we look at our macro and micro forecast for sectors, we do see that the combination of macro and micro forecast actually points out to cyclical sectors outperforming in the next 12 months. Communication services, financial, industrials, IT, real estate, all of those sectors are cyclical of nature. And the classic defensive sectors like consumer staples, healthcare, and utilities, all in negative territory. And more recently, information technology industrials advanced even further in their attractiveness, while materials and utilities kind of receded. So when you look at the dynamics of the forecast change over the last 12 months, you can see that what you're looking at right now is a combination of macro forecast for each economic sector and bottom-up forecast, which is a product of underlying fundamentals of individual companies aggregated on the sector level. So this is the marriage. This is the product of both of them put together. And you can clearly see that cyclicals are still prevailing. Financials, communication services, industrials, and information technology. The devil is in details, though. So when we dive into the macro forecast, and here we're looking at a whole bunch of indicators like yield curve inversion and the shape of the yield curve, GDP growth, personal savings rate, vertical valuation spreads, etc., etc. So you get a holistic combination of 70 factors on macro picture, and that gives us slightly interesting, we still see a lot of cyclicals forecasted to outperform, but at the same time we see utilities propping up in the positive territory. It's not yet the totally alarming sign because other defensive sectors like consumer staples and healthcare are not really forecast to outperform, but it's still, it's worth paying attention to, and obviously that might be an early sign of a tiring or slowing down economy. When we look at the bottom-up picture here, it's a clear domination by cyclical sectors again, which points to a continued economic cycle. And the fact that utilities and consumer staples have been very costly because they've done so well, on the heels of uneasiness about trade wars and slowing world economy, we can see that from the fundamental standpoint, because they've become so expensive, the bottom up forecast is not very favorable for defensive sectors, and still points out the cyclicals outperforming. So to make the long story short, factor groups, we still believe in growth at reasonable price stocks to do well in interim. Trade war obviously is gonna probably determine whether we are gonna see markets going up or down in the next 12 months. And global economic expansion slowed down quite a bit, and but we do see early signs of it bottoming out. And should there be any progress in trade negotiations, I think you will see global economy growing up. The same logic, everything influences the bottom up, the factor groups we combine on each individual company and in aggregate for all the companies in S&P 500, all the companies in our large cap universe. So when you look at our macro score, which is a combination of value, profitability, yield, momentum, growth, and safety factor groups, for the top two quantiles of our large cap universe, so we take the best of the best stocks, right? And we compare the performance to S&P 500. You can see that in 17, fundamentals worked. In 18, after the trade war was initially announced, fundamentals stopped working. People, ran for, FANG stocks, large cap growth stocks, very, very small group of companies as the shield. Then again, there was a brief moment of people, start paying attention to fundamentals again at the end of 2018, early 2019. But then again, when we had another wave of a trade debacle, we see fundamentals receding again to safety and to a very small group of stocks which the market deems safe haven for now. But as long-term investors, we want to pay attention to the exposure of our portfolios to multiple group factors. And this polar chart depicts our strategical equity portfolio and its exposure to all important factors which historically have been instrumental in our performance, in the long-term outperformance. So you can see that our portfolio is very well exposed to most of the groups, and that's the green one, is strategical equity portfolio. The circle in the center, that's the exposure of our benchmark, right? And the orange is the exposure to those factors by buyable stocks from our stock universe. So you can see that our portfolio is very well positioned to capitalize on the exposure to all those important factors like profitability, value, growth, safety. So let's talk about what worked and what didn't in model portfolios. On average, again, we saw a pretty good contribution from communication services, staples, financials, industrials, materials, real estate. We did have some short-term upsets in consumer discretionary, energy, healthcare has been depressed for a long time because of political pressure. Some, uneasiness in information technology, especially in semiconductors. Those got hit by, the uneasiness with China. And utilities. Utilities have been one of the safe havens for investors, and we just didn't see appropriate candidates because of them being pretty expensive. So recently we rebalanced our portfolios, and I will talk to the changes in strategical equity portfolio. First of all, we kept the mid-cap tilt. We think there's going to be a resolution in trade dispute, and we believe mid-cap could really capitalize on that the most. We still have neutral posturing from the value growth standpoint, but we increase our GARP exposure as well. Still overweight in communication services, finance, industrials, IT, with emphasis on software. And we reduced semis a little bit and introduced a utility because of a higher, not imminent, but higher probability of the recession in the future. So those were the changes. Again, very well diversified portfolio from sector exposure, from size and style exposure, very balanced. Again, and blend here is the GARP, so you can see that from that emphasis, we still keep GARP very well represented in the portfolio. And the strategic dividend equity portfolio, this portfolio is designed to produce dividend yield. Right now, it does produce very healthy, on average, I think it's 4.5% dividend yield. So we maintain large cap posture in the portfolio. We did bump growth a little bit, reducing healthcare, increasing IT, and bumping utilities to overweight, again, due to higher potential in the future probability of a recession. So again, a very well balanced portfolio from the sector exposure, and from the size and style, obviously it's dominated by value, but we still have a very sizable GARP representation in the portfolio as well, 34%. That concludes my presentation. If you have any questions, please do not hesitate to reach out to Eugene Yashin at signetfinancial.com. Thank you so much and have a great day.